Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will talk about the beta adjusting factor returns.
Hello everyone, my name is Radovan Vojtko and Head of Research and CEO at Quantpedia. Today we will discuss the beta and what is the impact of beta on trading strategies. But firstly, let's discuss what the beta is. The notion of alpha and beta comes from a capital asset pricing model. We can read a lot about CAPM, beta, alpha, etc. etc. I will link the article from Quantpedia in the description of this video, but here I will quickly explain what the beta is, and then I will show you how to use the beta to build better trading strategies. So firstly, when we have a portfolio, we can try to assess what would be the future performance of the portfolio from the several measures. So we can take what is the risk-free rate, so that's the rate that we can obtain from short-term government bonds or anything like that. And then we have a risk premium. The risk premium is the premium that we have from holding the risky asset. The beta of the portfolio is the sensitivity of our asset against the market return. So the beta is the sensitivity of our selected security or our selected asset against the average return or against the market return. And then we have alpha, and alpha is the real outperformance of the selected asset when we adjust for the performance of the market and for the performance of risk-free rate. When we are telling about the beta as the sensitivity, or we try to explain the beta is the sensitivity of the selected stock or selected portfolio against the market. What is the impact of the beta on selected securities? So there are a lot of strategies that work with the beta. We can use the keyword beta factor from our list of keywords to list or select the strategies that are working with this measure. I will just show you the first one. It's called the backing against the beta factor in stocks, and then we will try to find out what is the impact of the beta on other anomalies. So the idea of the beta is that when we have the security that's more risky, so it means it has the higher sensitivity against the movement of the market, we should have the higher performance. And of course, when we have the security or stock or anything that has a lower sensitivity against the overall market, we should have the lower performance. But the truth in the real world is that it doesn't work easily this way. So the statistic shows that the behavior of the stocks, of the high risky stocks, delivers lower risk adjusted returns, and the low beta stocks, so the stocks that are least sensitive to the market movements, they deliver the higher risk adjusted returns. So we can go long of the portfolio of the low beta stock, leverage to beta of 1, and we can go short on a portfolio of high beta stocks, the leverage to beta of 1. We have the anomaly performance. This betting against beta factor, it works well in stocks, it works well also across industries, etc., and then across the countries. I mean, we can build this strategy very easily, as it was written in the description. So we can use MSCI US Equity Index, we can use it as a benchmark, and to calculate beta of all of these stocks from our investment universe against this index. We can rank the stocks and assign them to portfolios, low and high beta. And once again, we can go along the low beta stocks, short the high beta stocks. But what is the most important thing is that we are not building the portfolio that is zero cost on a dollar basis, but we are building a portfolio that is zero cost on a beta basis. So it means we leverage the portfolio of the low beta stocks and we leverage the portfolio of high beta stocks. So we have a so-called zero beta portfolio, not dollar neutral portfolio, but a beta neutral portfolio. And now the question is, what are the implications of this strategy on other assets and other strategies? So there is a very interesting research paper from David Blitz from Robeco Quantitative Investments, and he is showing that this beta adjustment can be used not just for building long-short portfolios that are solely built on beta anomaly, but we can use this beta neutral way of building portfolios also for other equity factors like value, momentum, profitability, etc., etc. It shows that these factor construction methodologies are significantly better than dollar neutral or size neutral portfolios. Why is it so? They tested 150 factors in their sample from 2004 or something like that. And what they saw is that most of the factors in their sample, they exhibit a positive premium, also they have like positive performance. When they build the sample going long stocks or decile of the stocks that should have a positive performance, and going short decile of the stocks that should have a negative performance. So all of the 150 factor strategies, they have a positive premium, but they have a negative long-term market beta. And what does it mean? So the negative beta values for all the remaining factors, they mean that when we do not adjust long and short portfolio by beta, but when we go long and short based on the dollar size or what is the dollar value of both portfolios, the negative beta means that the factor exhibits strong performance mainly during the bear markets. And because from 2004 there were not a lot of bear markets, I mean we were most in a bullish period, it means that the performance of the factor was significantly lower than it could be. When we correct our portfolios and when we build the beta neutral portfolios, so when we go long stocks and short stocks and calculate the weight of the stocks based on the beta, not on a dollar value of the stocks, we would get significantly better performance and significantly higher Sharpe ratio. So let's take a look on pictures. Here we have annualized raw returns for the factors from 1963 until 2021 for so many anomalies from the whole sample. And in exhibit 2 we have a market beta exposure of the factors. So we will see that most of the factors have a negative beta exposure, and then it works exactly in the way as the Blitz proposed. So it means during the bear markets the strategy gains a lot of the money, but during the bull market the strategy are not performing so well. If we try to neutralize the beta exposure, so instead of going 100% of stocks long and 100% of stocks short for each anomaly, we calculate the beta adjusted long and short log of the portfolio, we can have strategies or we can have factors with significantly better Sharpe ratio and performance. So that's the impact of the beta on factor returns and how we can beta adjust factor returns. The idea is very simple, very easy, but it's really great. The idea comes from the original betting as the beta factor in the stocks, and we can use this idea to improve all of the other factor strategies in equities and in stocks. So thank you very much for attention. I hope that you like this idea and I hope that you liked the blog post. If you want to learn more, feel free to visit quantpedia.com and our blog, read the original research from David Blitz, and I hope that you will join me in the next video. And one last thing, please subscribe to our channel. It will help us a lot. Thank you very much.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.